Hello, welcome back to another YouTube video. We're going to look at assessing competitiveness 3.5.1 and you're going to look at interpretation of financial statements. All I ask for is a subscribe and like and hopefully enjoy the video. So a statement of comprehensive income, again, also known as a profit and loss account, shows the firm's revenue, cost and profits. And different stakeholders tend to have different interests. So shareholders, the main one, they look at profitability in the past. The higher the profitability, the higher dividends can be. Trends also show how risky a firm is. If the profits fluctuate, so they go up and down, this shows that the firm is risky, whereas a steady increase in profits over time is safer. Shareholders would like to see how much profits are being spent on dividends as well. The more the better for the shareholders. And lastly, a good firm can increase revenue without increasing cost too much. For all of these points, the shareholders generally look at like the revenue and the profits and like expenses over like a couple of years, just to try to find overall trends. Then you have managers. They're more concerned about the revenue and expenses of the firm. That's their main issue. If revenues are decreasing or expenses are increasing, then this is bad for the firm. They may have to think about ways to overcome this, what they could do. Profit and loss accounts might be made for different departments to help identify where costs can be reduced. That way you can see which departments may have higher costs than like other departments. And lastly, managers can compare their financial statements with competitors to see how the firm is performing. This will allow the managers to make a decision about what they need to do differently. Also, loan providers are interested in a business's profit and loss account. They're interested specifically in the operating profit, as this is where the interest on the loan is paid. A low operating profit will likely make the loan provider hesitant to give the firm a loan, as they may not be able to pay it back. Suppliers, they look at a firm's revenue in the past to see if it's been enough to pay other suppliers. So obviously the suppliers want to get paid their money and on time as well. And lastly, employees may be interested in a profit and loss account. Generally speaking, an average person doesn't look at their company's profit and loss account. But if you're someone, that is, such as some employees, they could be interested in the firm's profitability. A profitable firm is likely to continue trading and maintain employment. Also, workers may look at net profit. This could indicate whether a firm will give employees a bonus or raise. From this page, make sure you definitely know all the shareholders and managers' points, as they're very important. And then maybe you could just try and remember the loan providers and suppliers a little bit. The employees, to be honest, I don't think that'll ever really pop up in the exam, so you don't have to remember that one. But that's just there for for extra information for you to read about. So now we're going to look at a balance sheet. This shows the assets and liabilities of a business. This shows how much a business is worth. Again, the balance is useful for stakeholders. Just to say, it's more specifically useful for shareholders, but we'll look at a few. So comparing balance sheets on the same date in different years allows shareholders to identify trends, such as their assets have increased, their liabilities have decreased. That will be good for the shareholders to see. Shareholders can use a balance sheet as an indicator whether profits will increase. For example, a quick increase in non-current assets, so assets they buy for the long term, like factories, etc., shows that a firm has invested in property or machinery. There we go. This means the firm is investing in a growth strategy, which may increase profits in a medium time. Therefore, the shareholders will get more dividends. An increase in reserves also suggests an increase in profits. This means a business may have more cash, and shareholders may get higher dividends. Reserves are just cash, cash to spend, so you have more. And that's obviously because you get more profits, you have more cash to hold back in reserve. Also, shareholders may be interested in a business's sources of capital. A firm with a lot of loans has to pay them back for interest, so there's a risk that a business may get little profit after these have been paid. Also, now managers, they may look at whether a firm has the financial flexibility to acquire capital if it needs to. This means a business can cope with borrowing money rather than selling off its non-current assets. A business can cope with more debt from long-term loans if its net current and non-current assets are larger than the non-current liabilities it will have when it takes out the loan. In simple terms, what that's saying is, if the net current and non-current assets are greater than non-current liabilities, you can take out a loan and be okay. That's basically what it's trying to say. I would say again, try to remember all those bullet points as they're really helpful. They will be good in your exams. Now let's look at solvency and liquidity. Liquidity is the ability of a business to turn assets into cash, and solvency, a business' ability to pay debts. If the current assets are greater than current liabilities, then it is solvent, and obviously vice versa. So the managers and the owners, also known as shareholders, they look at a firm's solvency plus liquidity to see if the firm will go bankrupt. This can allow them to make decisions to prevent this from occurring. Suppliers will look at the balance sheet to see how liquid a firm's assets are and its solvency. A solvent firm with more liquid assets will be better at paying bills on time, and this helps suppliers decide whether to offer the firm credit and even trade with them. Then we have loan providers. They want to know if a firm has the ability to pay back loans with interest. A firm with assets much larger than its liabilities will usually be able to do so. Again, remember those 3 bullet points as they're helpful. Apart from that, that's the end of the video. All I ask for is subscribe and like and share with your friends. As I always say, I just get to the point and give you what you need without wasting your time. And thank you for watching.